So in day 4, we're talking about the different levels of support and resistance, different types of support and resistance. So there's 3 different types of support and resistance. A lot of professionals call it supply and demand, with demand being the support and supply being the resistance. Because when there's a higher demand, price goes up. When there's a higher supply, price goes down. So the 3 types of support and resistance. So in this, you have what's called your horizontal SNR, so support and resistance. And then you have your diagonal SNR. Then you have your dynamic SNR. There we go. So you got horizontal, diagonal, and dynamic. So let's start off with the horizontal one. So horizontal support and resistance, that would include your price zones. Make that a little bit smaller. That would include your price zones, your Fibonacci levels, and your whole number quarter points. So let's start there. That's your horizontal one. So with horizontal, with your price zones, we went into it a little bit in a previous lesson. But a price zone is basically a point in the market where price likes to react from. So with me just looking on the charts now, this jumps out to me. Why does it jump out? Because I have this movement here. See that those little reactions in that zone telling me that things happen when price reaches this zone. We can even include this one as a second touch. So things happen when price get into that zone. Like say if it's harder for you to recognize it, you just go down to the line chart and it'll give you those little areas where price makes that little pivot from around that level. If we were to look for another one on the chart, what would jump out to me would be this area here. Let me delete that. Why? Because you have this zone, you have this going on, you have that going on, you have this, and you have this, that little retest there. So it becomes easier for you to see it on the line chart. And this is your basic price zone, just looking at where the market reacts from. So let's go back. Next, you would have the Fibonacci points. So Fibonacci Get rid of that. So a Fibonacci is basically special numbers that price reacts from. So let's see here. In nature. Share. So if you look, Fibonacci is more mathematical, taking highly advanced mathematics into the charts. And it's not necessarily you having to do this math. The numbers are already laid out for you. So this gives you an idea of things that are made in a Fibonacci sequence. Let me go back and show you what the Fibonacci actually is. So let's see right here. So you see there's different values, there's different number values. And the main one being the golden ratio, which is 61.8, or the reverse, 38.2. Those look familiar because when you use a Fibonacci tool, those are the two main ones that are on any Fibonacci tool. And if you look, let's go back here. It's just the reason it's such a golden ratio because there's a lot of different calculations that equal out to that same ratio. So in nature, the leaves grow in a certain way, grow in a Fibonacci way. The rose petals, hurricanes. And let me show you something else. So let's see, Fibonacci. Let's delete this. Let me show you just the basic look of it. So you take this look here, right? This gives you a good example. This mathematical, I guess, shape is the same shape that goes into the plants or snails. It gives you more examples. See how it matches up with the snail? And the reason that this is so significant on the charts, because the charts is just basically a element of human psychology or natural psychology. So when you're looking at all of these different examples of Fibonacci in play, trading is one of them. Let me show you why. So let's go back to the charts here. So we talk about the 61.8 retracement, right? So let's look at nice even points. Let me do my basic one. Which one is my basic one? Here. So we look at Fibonacci in motion, right? So you see here, and let me show you why it's so important. Let's do this example actually. Let's do the high to low example. All right, perfect. Do you see how price reacts in these areas? Just by drawing a Fibonacci, you see there's a lot of respect in the area. You see it here, see it goes back in here, and you just keep going. This is why Fibonacci is very powerful. Even with the Fibonacci extensions, that price reacts in those areas. I can go to another chart and do it again. Let's do it on a bigger move. Let's do this. Just throw it up there. All right. And watch what it does. How far back am I? Far back enough? No, I'm gonna go further back. Let's go further back. Auto. let's go further back. Let's delete that. Let's go the bigger move. Go from down here all the way to up here. Back, this starts in April, right? See how price is reacting in those points. So Fibonacci is in play in the markets. Say if I go further, see here, see that touch there? Perfect touch on the 38. The more touches are going to happen at the 38 and the 61.8 when you do it in this way. And then the 78.6. It's going to be in that order. But you'll see that all the levels get respected. And you can literally, to an extent, put a Fibonacci overlay on the entire chart like this and have a level of support resistance that you can actually trade. And it literally, no matter what you do, so let's find it. Here's another big move. Delete that. Just over and over again. You got that movement here. You got that perfect touch on the 61.8 there. See another perfect touch on the 61.8. A touch on this 23.6. See how it just falls in line to these numbers. See another earlier today, a perfect touch on a 61.8 from a chart I drew, a Fibonacci I drew for April. Today, that same 61.8. So let's go here. That same 61.8 from April was respected for a perfect entry that was 60 pips. It's not a coincidence. Just like this where it shows up everywhere, is here too. That's Fibonacci. What pair was I on? I think I was on GCAT again. Let's see, what pair was I on when I was doing? I think it was this one. Yep. All right. So that is your Fibonacci. Then you have what's called whole quarter points. So a whole quarter point, we go here, are just whole numbers. So like if you see like a price of 1.100, and then you see a price of 1.200 or 2,000, like those points in the market to where they're easy whole numbers. That would be a whole point, right? Then you have your quarter points, right? So like if we take the quarter points between 1.1 thousand and 1.2 thousand, you would get something like this. So you would have 1.1250, 25. Then you would have 1.1500, and then you would have 1.1750. Those would be quarter points. These are numbers that are used on a high scale, on the institutional scale. So got quarter points. So let's look at some whole and quarter points that we would see in this chart. All right, so let's go here. I see 1.2 thousand. So I'm gonna take a line. I'm gonna take a line here. and then just change it to 1.2000. And then I'm gonna copy this line. And then I'm gonna take that and put it at the next quarter point down. So 1.1750. 1.1750. So these are what's called like your, oh, and then you have your half points. That's what I was missing. Half point. So the half point would be here. The half point between 1.1000, 1.2000 be 1.1500. But these are what's called on a quarters theory, those are what's called your large points, right? Then you have they don't necessarily call them small points, but basically you have I'll just say it's small quarter points on your smaller scale, which are more, the smaller scale is what's more commonly traded, right? So instead of taking a whole number of 1,000 pips, the whole number would be 100 pips. So like, for example, let's look at one that's relevant. So you would have 1.900. Oh, did that wrong. 1.9900. There we go. Like that. And then these are more commonly traded. 1.19800. So let's use those. So those would be your small. This would be your small hold point because you're using 100 pips. So large hold point is 1,000. Small hold point would be 100 pips. So equals 100 pip intervals. And then we'll go half points. I don't really use quarter points on a small level, but I'll use small hold points and small half points. Small half points. So that would look like this. So you get 1.99550, 1.9950. And then you would have the next one without using this one, you would have 1.9850. So let's use those numbers. Let me show you why this is significant. So let's clone this line again. So basically with that, like in what scenarios you will use Fibonacci and a quarter point. If you get a Fibonacci, you put it up and that Fibonacci happens to be near a quarter point or a whole point and they're on the same line, that's a great zone. That's a great level. You're just building evidence when you're trading. If you find more things that confluence and support each other, then that's a better scenario for trading. You have a better trade. So which one was I at? 900. 900. Nope, I did that wrong. 0.1. There we go. 1.1900. And then let's use another one. I'm going to do 2 more lines and I'm going to show you how significant these lines are. 0.1950. And 1.1850. And one more. $1.1800. So if you look at the charts at these points here, so move that out the way. Sort of the same thing as the Fibonacci, where you have price continually respecting those points. See there, see right there. And sometimes they get like within 5 pips of it and react. But you'll have these levels. Now, I don't trade just off of quarter points. This is just something that, or whole or half points. These are just something that I use to help confirm a trade. But you see that same thing happen where this trade here hit that on the spot this morning and went down exactly 50 pips to the next significant point. That's why this is important. So the next one we have are your diagonal support resistance. So let's move this up. So your diagonal support resistance. So these would include your trend lines, your pitchforks, and your price channels. So trend lines, pitchforks, and price channels. So these are pretty self-explanatory on a description level, but let me show you what it looks like visually. So let's get these out the way. The first one would be, we'll use as a trend line. So a good trend line, you have 3 points of connection, right? So right there, that would be a trend line. So you have your point 1, and then you have your point 2, and then what most people trade is point 3 on a trend line. That third touch is your most safest touch in the market. And you see, now that you know about horizontal support resistance, you see that this is already a level as it is. So you have, confluences. This is how you start building a trade. 61.8. So you got a trend line, you got a horizontal resistance, and you got a Fibonacci all in the same spot. This looks like a very good area of trading. You have a lot of confluence. But for trend lines, that's how you would look at a trend line, right? So your next one, just another example would be here. And the way you draw trend lines, it took me forever to really get it down. You're really looking for touches. You're not necessarily trying to get right on the spot, but you're trying to be relevant when you're drawing it. So let me show you what I mean by that. Let's zoom in. So you see how I have a low point here, like you're just measuring the swing point. So like we talked about, swings, like movements in the markets. So you're just measuring those points. So if you had a movement from here and it came back down to create like as a retracement, then that would be a good area to start a trend line. And not all trend lines work. It's not going to be 100%, but it's going to help you structure your trades. The next one would be the pitchfork. The pitchforks is a simple tool, but it creates very complex but very precise trading entries. So let me find my pitchfork. And the way you would draw a pitchfork is you would take a low, then go to the next low, and go to the next high. Now with a pitchfork, you see how this isn't quite even. There's two versions of a pitchfork. You have your standard pitchfork where you can just draw this and price looks even. And then you have your modified pitchfork where you take it and you take these two lines here or one of these lines and line it up with the markets. So if I wanted to line that one up, that would be my area here. Pitchforks are a little bit harder to draw, a little bit harder to use. Let me see if I can find a clean area for a pitchfork. Here we go. And you just want to create where you have your immediate touches. So you see how I'm lining it up with the rest of the chart. So you want to line it up and kind of do like a trend line and line it up the best you can. So that's probably as good as it's going to get. Watch what happens as I go beyond in the chart. You see you have a perfect touch there. You have a perfect break and retest here. Touches there, breaks and retest there. Perfect break and retest there. See all these touches in the market off of these pitchfork areas. So when you draw it right, it'll continue to be a viable source of support and resistance. There's a small margin of error when it comes to pitchforks, but if you line it up correctly in the beginning, you'll have accurate areas. So that would be your pitchfork. So this is like trend lines on steroids. Like think of trend lines and think of Fibonacci at the same time. That's what a pitchfork is. So that's one of your diagonal support resistance. The other one would be considered a price channel. So a price channel, think of it like a tunnel where you have things going in between, nothing going outside of it. So a price channel would look like this. Where you have price moving between an area like this. So the way you start with a price channel, you could start a price channel like at this point, right? So you have 3 points in the market. So you have point number one was this low. So 1, 2, 3. So when you have two lows, one high, you can do an upward price channel. When you have two highs and one low, let me see if I can find a quick example of that. You can do a downward price channel. So two lows, one high. I mean, two highs and one low. So we have two examples. Here we go. So you have a high, a low, and another high. So what you can do is you can create a price channel to match it. That was a short-term price channel, but a price channel nonetheless. That price channel would have got you this trade here and got you that take profit. You know, it only gave you one trade. You know, most good price channels will give you multiple trades. Let me see if I can find a longer price channel. And you just have to train your eye to it. This is about making you aware of it, just like with the candlestick blueprint. So two lows, one high. So let's go here. This is a bigger channel. But as you get more familiar with it, you see how price continues to trade within it. You had a breakout. You had a breakout here of the channel, and people trade channels in two different ways. They trade the channel breakouts. So when price breaks out of channel, like if you would have took it here, this would have gave you some pips, gave you 20 pips, or they take channel breakouts and retest like this one here. So you have a breakout, you have a breakout here, then a retest of the channel, and that would be your trade. You see how that would have lined up pretty nicely. Just like last class, I had one mentor who only trades head and shoulders. I have another mentor who only trades price channels, and he'll look for trades just like this. So you see here, you had this little retest trade here, and then on this channel you had the breakout and the retest there. So those are your price channels. So let's delete those. Go back to here. So that concludes your diagonal support resistance. The last type is the dynamic support resistance. That's what the last type is. So your dynamic support resistance are going to include Bollinger Bands, moving averages, and Ichimoku clouds. Those are your three most common dynamic support resistance. So if we start off with Bollinger Bands, let me get rid of this. Let's go back a little bit. Auto. So that way you can see it. If we add a Bollinger Band in here, Bollinger Band, it's an indicator, but you can use it as support resistance. So let's zoom back in. So you see, this is what makes the Bollinger Bands dynamic. This is the rule with them. So if you have, let me zoom in closer. If you have a Bollinger Band that's stretched out like this, let me show you the rules of Bollinger Bands. So you have where it's stretched out and it's expanding. That means momentum and what's the other word? Volatility is increasing. When you see the Bollinger Band start getting tighter like this, that means momentum and volatility is decreasing. The other rule, of course, is the upper band is considered your resistance and the lower band is considered your support. And it follows based off the movement of price. It uses a standard deviation of 20 periods of the price. And it creates this band. So you see here, one way you can trade it, let me get rid of this. One way you can trade it is using another form of confluence. So we can do something that's not as obvious. We can do a price channel, right? So we have two lows and a high right here. See if that'll let me do it correctly. Oh, there it is. Two lows and a high right there. You have your price channel and you have your breakout of the price channel and then your retest not only on the price channel, but on the lower band of the markets. And that created a buy scenario. If we let's look for two highs and a low. Let's look for a good one. Let's do this. Do this one here. Two highs and a low. All right. So you have a price channel here. And you see this is what you use to draw the price channel. You got your Bollinger Band, and you see you have a retest of the price channel and on the upper band of the Bollinger Band. That would have been a sell entry. If you could look even closer, what do you see? You see a couple candlestick formations. You see this inverted hammer. You see this evening star formation. So this is how you start using things in conjunction to find trades. Let's zoom out a little bit. Okay. Look here. This was a small trade, but still a profitable trade. You have a breakout and your retest of the channel, but it's also the lower Bollinger Band. You would have been able to catch some pips there. That would have gave you 22 pips. So when you start putting things in conjunction, start putting things in conjunction, then that's how you can really find trades, just by looking at the charts and building your analysis. Yeah, so like that's the third part of the Bollinger Bands, and thanks for reminding me of it. The third part of the Bollinger Bands is the middle line. So the middle line is telling you where the trend is going. So the middle line is going upwards, then the trend is up. So, and especially if the middle line is going upwards and price is above that line, then this, and it's not necessarily the long-term trend. Never think of it as the long-term trend, but the immediate trend, like the shorter-term trend, is up. So like if you're scalping or things like that, people, trade Bollinger Bands and go from middle to high or from middle to low if it breaks down. But that's another mindset. Now we're going to go over trends in the next video. But it's more so in a Bollinger Band sense, the middle line is considered, your trend. If it starts to go down, then you're looking for sales, and it doesn't change direction that often. So it gives you at least a short window of time, a good window of time to place a couple shorter sales. But I would never use the Bollinger Band as a means for my long-term trend. So the last dynamic one would be the moving average. And I like using the exponential moving average, because the exponential moving average, it puts more emphasis on what's currently happening versus what happened. So you get faster reactions, and sometimes you need that when you're looking for quicker trades. So you have your moving average here. Good moving average and it depends on what numbers you use, but a good EMA for support resistance would be 100. That's a commonly used one right there. And what you see is your intermediate trend and a form of support resistance. So you see here, price had a break and a retest of the EMA. So you see here, so it broke above and retested the EMA there. You had a second retest of it for another buy. You would have took that one, maybe you would have lost, but it would have gave you another short win for a sale on this retest. And you could literally, take some trades like that. Another popular one that's used is the 200 EMA for longer term, support resistance. You won't get as many entries, but the quality of the entries would go up. So you see here how price is going right on that 200 EMA. It broke above, it retested, Then it broke above and retested again. You know, say you combine it with something else like a Bollinger Band, for example, and you see you have those double confluences. You got your break and retest here of the EMA, and it's also touching the middle line. So you keep finding areas. You know, you got this touch right here where you can place trades using the moving average as a support resistance. Like say if you're you want to take more trades, you know, another popular one for EMAs would be the 62. Let me get the Bollinger Band off. At 62, you'll have shorter trade opportunities. So when you see a break and retest of a 62 EMA, you know, you'll have, you know, you won't be as long, you won't look for as long as pips or longer of a move, but you have steady movement. I like using the 62 EMA a lot when it comes to crypto because crypto follows the 62 quite well, especially on a shorter time frame. But you see, look, got a break and retest there, got a, you know, a touch there, you know, a retest of it here. It gave you a little small win, and then it broke above, retested, gave you a small win there. So it continues to play a part, you know, break and retest here. Continues to play a part in your trades. So the question now becomes, you know, what one or two or three of these will you use to be able to divvy up your trades and trade it? Now, if you have what's called our Arrow software, you don't have to worry about doing it because the software does it on an automated scale. But if you want to, you know, have more detail even beyond the software and maybe combine the software and maybe one of your methods that you like together, then you'll really have some really good areas to place trades. On top of the arrow strategies that are already present, and we'll get into that in day 6. Does anybody have any questions on any of the support resistance? Let me see. And then another thing while questions are going up, another thing that I like to do is when it comes to moving averages is have two of them. You know, one of a shorter trend and maybe one of a longer trend. And that way, I like it when it tells me, gives me an idea of trend, but the other aspect of it is it kind of confluences in certain areas. So you see here, this was a break and retest, and this was close to both moving averages. Now, this is a break and retest close to both moving averages. And you see, like, here's the difference. You see, if I'm going to teach this one, you see this area here, right? It broke above this moving average, but it's not above that one. That wouldn't be a trade because it's in the middle of it, going the wrong way. In this example, it broke below both of them and it's retesting both of them. It's below both of them, retesting both of them. That would be a trade, you know, this one over here. So that's how you kind of go between the two. But this concludes day 4 of the 14-day boot camp. And I hope that you got a lot of value from this one, because when I got this training, you know, a lot of light bulbs went off for me, because now I understood how to build a strategy for myself. When you have the understanding of the candlesticks, you have an understanding of your support resistance and how to really look at it and how to trade it, it can change the game for you. You can really understand Forex as a whole. But y'all have a great rest of your evening. The recording will be out soon. And let's continue to learn and eventually make a lot of money in these markets.